let's bring on board then Pankaj Murarka, who is joining in, CIO of Renaissance Investment Managers. Thanks so much for taking time out. And clearly, Pankaj, it's a lot of traction that's building up within the broader universe. Is it now the time for stocks within the mid and the small cap indices to prove their might versus the frontliners?
Good morning, and wish you all a very happy 15th anniversary to the entire team of Itino. I think there could be, given the kind of momentum that we're seeing in the markets and the SIP flows are clearly unabating, the underlying economy is still doing very well and fairly resilient. My view is we unlikely to see any significant capitulation in small and mid caps in the short term. What probably could happen is we could see sectoral rotations within the and stock rotations within sectors, but I think probably looks like we are in for good times, and why complain when things are going so good?
Right. Pankaj, hi, morning. Thank you so much for taking the time out on our birthday. But just, wanted to understand what is it that you're making of all the commentary around that we're seeing from M&M, especially from the takeaways of their analyst day. I mean, the stock is at 3,000, but our researcher was just telling us that brokerages are now calling it a sell, but still forced to up their price targets because the stock has been relentless and just been moving one way up.
It's actually, Aisha, one of the best performing auto stock in this cycle over the last 4 years. Uh, and I must say, even we have not captured the entire up move in M&M as we would have liked to be in hindsight. And probably, I think after the big change with Anish coming and taking over 5 years back, there's a significant organization reorg across organization. There's much more strategic focus. More importantly, there is a very significant discipline in capital allocation in M&M that I'm seeing in the last 5 years, which I have not seen in my last 20 years. So I think the group is much more sharply focused, and more importantly, they're very clear that all the businesses, the core business, auto business, or the other businesses, be it M&M Financial Services, be it life spaces, in some of these spaces, large industry segments, they have businesses which are relatively small, and they have a strategic plan that these businesses have to get into leadership positions in those businesses. And in last 5 years, we've seen that group companies have made significant progress towards that. So, my own personal assessment, the M&M Group core auto business and the group companies that I'm seeing in the last 4 or 5 years is very different than the M&M I have seen in 10 years before that. And in that context, I think, given that the economy is resilient, across the group, the businesses touches across different segments, right from tech Mahindra in IT to automobiles in SUV and farm equipment, which relates to agriculture, and then you have financial services and life spaces and so on and so forth. There's tremendous potential for all of these businesses to grow. Stock might look a bit rich in terms of near-term valuations over the next 4 or 6 quarters, but I still think from a medium-term perspective, I think the outlook for the group and business or stocks continues to remain positive, I think.
Okay, fair enough. That's the view on the Mahindra group of stocks. And just curious as well to get in your take as to what the road ahead spells for FMCG, because, there was that fervor that we witnessed within the space, and we attributed it, of course, to, the kind of election verdict, the rural push, the fact that there is policy continuity, valuations as well. But how are you looking at the road ahead long term for FMCG? Is there really an opportunity?
Absolutely. I think we've had a cyclical slowdown in consumption over the last 12 or 15 months, and that was partly because of one, there was a mean reversion to the revenge spending, which we saw post-COVID unlocking, where consumers just went on a spending spree kind of a thing, and people sort of overconsumed or overbought. And secondly, we had a failed monsoon last year, which contributed to some degree of rural distress, I must say. But I think now probably we're looking forward to a probably a normal monsoon this year, and probably that whole excess spending that happened during the revenge spending period has probably normalized. So probably my view is that we'll see a rebound in consumer spending going into the second half of this year and in festival season. And some of these consumer stocks actually have underperformed the broader market over the last 2 years, and some of these stocks are actually down 30-40% from where they were about a year and a half back. So my bias overall in consumer remains positive, but within consumers, we are more positively biased towards consumer discretionary than consumer staples, because we think the growth rebound in discretionary will be much more sharper versus staples. So probably we like staples, discretionary more than the staples, I would say.
Um, Pankaj, curious to know how you're reading into this news. I mean, it's still early stages yet, but the exchange filing from Zomato that they're looking at the movie ticketing business for Paytm.
I think structurally the deal to me looks positive for or a win-win for both the companies. Usually you don't get such kind of win-win transaction for both the parties. For Paytm, it makes eminent sense because they have challenges on their core business. It's better that they focus on their core business, and some of these other businesses which are ancillary sort of thing. Probably one, it will help them release their management bandwidth from some of those businesses and redeploy those bandwidth on their core business. Secondly, from a financial perspective, it's a loss-making business for them. So your losses to that extent or cash flows to that extent will be preserved and losses will be reduced, and you still monetize that business with a good value in that sense from a cash flow perspective or monetization of the business. From a Zomato's perspective, I think what has really worked well for them is their core business, food delivery, is profitable and generating significant cash, and those cash flows are now growing at a very high rate. Blinkit, there's a very high degree of visibility, will turn cash flow positive probably in another 2 quarters or 3 quarters at max, which effectively means Zomato is and will continue to generate significant free cash flows. For high growth companies like some of these tech companies with very low capital deployed, once you reach break-even points, you start generating huge amount of cash flows. For Zomato to buy this business and probably which is ancillary to their existing businesses and combine that with their dining business and probably build this into another lever of growth over the next 5-7 years, again makes a strategic sense because it has close linkages to the existing set of businesses. So probably I would think if the deal really goes through, it could be a win-win for both of them.
Okay, that's pretty interesting with respect to what's happening with Zomato.
But Pankaj, what about the defense companies? I mean, HAL has again got the RFP for procurement of 156 light combat helicopters. So the stock price action aside, what about the order inflow and the positive news flow?
Well, Aisha, I think that this whole momentum will continue. India has taken a strategic direction where we are the third largest defense spenders in the world after US and China, and 80% of our defense capital spending was actually on imports, and we were importing all of these equipments all these years for the last 50-60 years. Now, after having made this strategic shift, meaning I think one, obviously it's a very significant order from HAL's perspective, but the point I'm going to make, the broader point I'm going to make is probably we'll see many more such orders for many more such companies. The contribution of private sector to overall India's defense expenditure is still very small. It's a story which is evolving and it has a very long runway to go. You look at US, some of the largest companies, some of the defense companies are amongst some of the largest companies in US. When you talk about Rafale, Boeing has a big defense business and so on and so forth. Lockheed Martin, a huge conglomerate. Why cannot, if we are the third largest defense spenders in the world and our defense spends are only going to increase, then there is no reason that why cannot we create global champions in defense from India, like we've created in some other segments of technology. Let's say we create some of the global champions in IT services from India. So there's no reason why we cannot create some global champions from India in defense as well. So I think the story has a very long runway to go. And while these orders look very large, and they are actually large from what we have seen of the sector over the last 4-5 years, but the point I'm going to make is the sector is still in its infancy, and I think it's a very secular thing for the next 20 years because India, given the way world is designed, and given that the fact that India as a country geographically shares borders with two nuclear powers, which no other country in the world has that kind of a geographic composition, India will continue to spend significant amount of money on defense. So, and for all of these companies, I think there's a huge, huge opportunity for probably the next 15-20 years, probably, I would say.
All right, Pankaj, good to have you on board. Thank you so much for joining in and sharing with us your thoughts on the markets as well as individual stocks.
If you like this video, then like, share and subscribe to ET Now.